On a scale of 1 to 10, this investment opportunity is a 10. What's up, everybody? Michael Silva here. Welcome to the channel. If it's your first time,
high five.
If you've been here before,
smash the like.
In today's video, I'm going to be discussing what I believe to be the best investment opportunity once in a lifetime right now. And I'm not just saying once in a lifetime just to throw it out there. I'm going to show you actually quite literally why it's once in a lifetime. Because, well, it's never happened. So what is this that I'm talking about? I am talking about silver. Now, before you just go, hey, I'm just gonna go buy some silver now, please listen to this disclaimer. This is for entertainment and educational purposes only. I'm wrong 100% of the time, just like Peter Leeds says. Now, during this video, I'm gonna discuss multiple aspects as to why it's such a good opportunity. We're gonna be digging in deep to some charts and some historical data, and I do my best possible to make it very easy to understand, and you will see these crazy correlations. We're going to go back as far as 2008. You can go back farther, but I didn't want to make a video that long, so we're going to go back to 2008 and then we're going to fast forward to today. This is what the video is going to look like. I'm going to be first discussing what the gold to silver ratio is and its importance to this whole idea that I'm talking about silver being the best investment opportunity. And then we're going to go back to 2008. We're going to look into the Federal Reserve speech about systemic risk, and we're going to line that up with the balance sheet that the Federal Reserve has. Look, I'm probably losing you right now, but I need to make sure that you listen all the way through and then back it up a little bit and re-listen to it if you need to, okay? These sound like big, heavy-duty things, but I promise you they are not. Once you see the charts, you're gonna be like, okay, that makes sense. Easy enough. So, yes, like I said, we're gonna be talking about the gold to silver ratio, and then we're gonna go into 2008 information, and then we're gonna fast forward to 2020, kind of conclude it right there. Okay, so let's get into it. What is the gold to silver ratio and why is it important in this investment opportunity? Well, the gold to silver ratio is simply that. It's a ratio of how many ounces of silver does it take to buy 1 ounce of gold. Now, what's so cool is they actually chart this out, and you can chart this out using stockcharts.com, which I did, or many other services. But historically, the silver or the gold to silver ratio has been 50 to 1. 50 ounces of silver buys you 1 ounce of gold. The higher that ratio goes is basically saying, hey, silver is a good value. And the lower it goes says, hey, silver's probably not the price, it's not at the price to buy right now. But what is more interesting to the gold to silver ratio is ever since the fiat monetary system came into play, you can see a correlation between when the Federal Reserve brings stimulus into the economy and what happens to gold silver ratio. And that you need to understand, and that is what we will be discussing in detail on this video. So without further ado, if I have not lost you yet, please pay close attention, ask questions in the comments section, let me know your thoughts, or if I'm just some crazy person. But let's go ahead and go back in time to 2008 to when Ben Bernanke came out and talked about systemic risk. In August 22nd, 2008, Federal Reserve Chairman Ben Bernanke came out and gave a speech on reducing systemic risk. And in that speech, he wrote, "The second element of our response has been to offer liquidity support to the financial markets through a variety of collateralized lending programs." He then goes on to say, "I have discussed these lending facilities and their rationale in some detail on other occasions." Well, he did actually, yes, in 2008 of May, he talked about liquidity provisions by the Federal Reserve, and in that he wrote, "The notion that a central bank should provide liquidity to the banking system in a crisis has a long intellectual lineage." Remains one of the, and then he goes on to say some more about that. Basically what we're getting down to here is we're talking about injecting the economy in the financial markets with money, also known as quantitative easing, money printing, repos. There's more, it goes on and on. So he says, briefly, these programs are intended to mitigate what have been, at times, very severe strains in short-term funding markets, and by providing an additional source of financing to allow banks and other financial institutions to deleverage in a more orderly manner. We have recently extended our special programs for primary dealers beyond the end of the year, based on our assessment that financial conditions remain unusual and exigent, pressing, or demanding. We will continue to review all of our liquidity facilities to determine if they are having their intended effects or require modification. And then he goes on to say, in this regard, some particularly thorny issues are raised by the existence of financial institutions. We're talking about banks here. That may be perceived as too big to fail. Do you remember the bailouts? And the moral hazard issues that may arise when governments intervene in a financial crisis. As you know, in March, the Federal Reserve, this is 2008, acted to prevent the default of the investment bank Bear Stearns. For reasons that I will discuss shortly, those actions were necessary and justified under the circumstances that prevailed at the time. However, those events also have consequences that must be addressed. In particular, if no countervailing actions are taken, what would be perceived as an implicit expansion of the safety net could exacerbate the problem of too big to fail, possibly resulting in excessive risk-taking and yet greater systemic risk in the future. We are dealing with that now. Mitigating that problem is one of the design challenges that we face as we consider the future evolution of our system. Now, here in the article, it gets pretty interesting too as well. Now, I'm almost done with the 2008 portion, but I want to hit this part of his article. The Federal Reserve and other authorities are also focusing on enhancing resilience of the markets for tri-party repurchase agreements, repos. In tri-party repo market, primary dealers and other large banks and broker-dealers obtain very large amounts of secured financing from money funds and other short-term, risk-averse investors. We are encouraging firms to improve their management of liquidity risk and to reduce over time reliance on tri-party repos for overnight financing of less liquid forms of collateral. Well, the reliance of these repo was not fixed in 2008 because in 2020, we are doing these repos right now. Actually, the Fed just came out and said they're going to be increasing the amount of repos that they do overnight. We're now going into $1.5 trillion of stimulus. In the longer term, we need to ensure that there are robust contingency plans for managing in an orderly manner the default of major participant. The default. So you got to make sure that these don't go bust. We should also explore possible means of reducing the market dependence on large amounts of intraday credit from the banks that facilitate the settlement of tri-party repos. You failed. It's all a bunch of fugazi. None of it worked. The attainment of these objectives might be facilitated by the introduction of central counterparty, but may also be achievable under the current framework for clearing the settlement. Okay, that was in August 2008, his speech, Reducing Systemic Risk. Okay, August 2008. I want to show you a chart of what the balance sheet of the Federal Reserve looks like and what took place in August of 2008. This right here is the credit and liquidity programs and the balance sheet of the Federal Reserve. Okay, this is total assets in millions. So this is what happened in August. Look what happens in just a short period of time from the end of August to basically 2009. So 4 months. Look at the balance sheet go from flat to skyrocketing up. That's absolutely insane. This is why I want to show you this, okay? It's talking about the gold to silver ratio. This is where the correlation comes into play. So there is a correlation between the gold and silver ratio to the monetary policy that the Federal Reserve used. So what happens in 2008 to the gold and silver ratio? Well, let's see. This is the gold to silver ratio. Now, we've already discussed what the gold to silver ratio is when it goes high and then when it goes low, but I want to show you here the correlation between the two charts. Here is August of 2008, right here. What happens when the balance sheet and the money printing begins? The gold to silver ratio expanded significantly. Look at that shot up from 52, which is basically the 20-year average. The 20-year average of the gold to silver ratio is right in the range of 40 to 1 and 50 to 1. That means it's 40 ounces of silver will buy 1 ounce of gold, or 50 ounces of silver will buy 1 ounce of gold. And it skyrocketed where you can buy 85 ounces of silver for the same price of 1 ounce of gold. It's crazy. But what does that mean for the price of silver? What happened to the price of silver during this time? Well, let's take a look at that chart. Okay, so now this here is the price of silver during August 2008. Now, pay very close attention here because what happens is very interesting. August 2008, the price of silver was $13.69. And what happened shortly thereafter? The Fed came out and spoke about quantitative easing or increasing the balance sheets. Well, the price of silver took a drop to $9.73. That right there is a 25% hit to the price of silver. Yes, that jump looks really small, but that was a 25% hit. And I want you to remember that number. It went down 25% in just a short period of time. And then what happened? Boom! Up to $48.60, the price of silver. Now for a little story. When things go from down here, it's from $10 to a 400% increase, a lot of people start talking about these gains and this amazing investment opportunity, and people rush into it. This is where the supply and demand kind of come from. The demand for silver went sky high and the supply goes lower and lower. And you got to get ahead of these curves. And the gold to silver ratio is what's going to tell you when that time is. It's what experienced investors use. I wasn't experienced in 2011, so I started buying when I heard other people talking about it. $48. I remember buying silver at $30, $40 an ounce, okay? And what happened? Well, it just tanked. What happened to the gold and silver ratio during this time? Okay, so in 2008 in August, which we already discussed, the Fed came out, right, and discussed about systemic risk and what they're going to be doing to handle the problem. The gold to silver ratio skyrocketed up to a high of 87. So what happened when I started buying silver? Well, I started buying silver, like I said, when the price was already at $43. Well, scroll forward to 2011 when I started buying. Here's 2011. Tank, 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 tank. I started buying it way down in here when the gold and silver ratio was already low. This is what happens when you drink the Kool-Aid. When you all of a sudden hear about things at the wrong time. This is literally what happened in Bitcoin when everyone started, I think it was the end of 2017 or 18, when in December when it just hit $20,000, then everybody and their mama, they were talking about buying more Bitcoin, and they did, but they bought it at the worst time. This correlation is absolutely incredible. So, why am I showing you this back in 2008? Well, let's fast forward to today and discuss what is going on with the gold to silver ratio. But before we talk about the gold and silver ratio, I want to bring it back to the Federal Reserve. Now, this is January 2017, right back in this range. And then all of a sudden you see this drop off right here. Well, what was going on during that time? Well, if you remember, Jerome Powell, our Federal Reserve, was talking about lowering the balance sheet, right? So how do they do that? They increase interest rates. They started moving them up ticks by ticks. And as you can see, it dropped down a little bit, right? But in historic times, I mean, it didn't really drop off all too much. Okay, but now what's interesting is what do we see going on right now? Well, if you come back over here, September of 2019, what do we see happening? Well, we see the balance sheet starting to fly up. See, it was this long, gradual drop that wasn't even that much. And then in just a short period of time, we're starting to see the balance sheet expand. What's crazy is the Federal Reserve just came out and announced more stimulus into the economy, more bailouts, pretty much bailouts to everything. And now we mix that in with the cerveza sickness that's going on. This right here, this isn't anything. This is going to fly to the freaking moon. You can't stop this now. It didn't work in 2008 when he talked about repos and pushing liquidity in the markets. It didn't solve the systemic risk that he was mentioning, and it's just going to get a lot worse. I mean, it's right here. It's right here on the charts. And like, I'm not even an educated econ, whatever. I can't even say the word. But this just goes to show you don't need to be that smart to notice and understand this. Regardless, let's go ahead and look at what's happening to the gold and silver ratio. So now this is the gold to silver ratio, and I brought it to right here in September, right? We just saw the Federal Reserve chart and what was going on when we just saw that huge increase to their balance sheet. Does this look familiar? Well, guess what? You're dang straight it does. So September, and boom. Where are we right now? We're at 95.27. Okay, that was higher than 2008, but this isn't actually even showing how high it went. You see the RSI, how it's way over there? It's actually, and it's not showing you here because it's not a candlestick, it's a thin line chart. It's at 104. The gold to silver ratio is at an all-time high. It has never been this high in millennia. Never once, ever in the history of silver and gold. This is the highest. This is why I say it's a once-in-a-lifetime opportunity, because right now, you can buy over 100 ounces of silver for 1 ounce of gold. This right here is telling you that silver has an incredible value. But there's something else I want to point out. What's going on with the price of silver? You see, remember in 2008, I mentioned that the price dropped 25% when they came out and they started talking about all these stimulus programs. So what's going on with the price of silver right now after they just came out and talked about stimulus? This right here is the price of silver on January 1st, 2020. It was at $18. And when we started talking about the cerveza sickness and the Fed coming in to stimulate the economy with overnight repos, which they've been doing, the price came down to $14.50. That is a 22% drop. 22% in a short period of time. What we're seeing right here is exactly what happened in 2008. So, why am I saying that this is a once-in-a-lifetime investment opportunity? Simply, I'm saying it because silver is super undervalued. The most it has ever been in terms of the price of gold in history. We can see this. If this plays out like 2008, silver is going to break those highs that it hit in 2011. That was $50. We can see the price of silver hit triple digits. This is going to be a monumental move in the price of metals. You see, they're putting in so much money. The Federal Reserve is putting so much money and creating so much inflation, which inflation is the expansion of money. This eventually fails. It will fail. And silver not only has monetary value, it has industrial value, which creates more volatility. I honestly think that silver is an absolutely incredible opportunity. If this pulls back anymore, I know I have to load the boat. I have to buy more silver. Right now, I'm holding only 500 ounces, and I still feel like that's not enough. Okay, 500 ounces, I just do not think that that's going to change my life if it even goes to $100 an ounce. So, there you have it. That's kind of my whole thought process on what's really going on. That's why I believe that silver is an incredible investment opportunity. We're seeing, and by the way, you can go back even farther than 2008. You can go to each financial crisis that the Fed came in to stimulate the economy. It does the same thing. So this just to me is absolutely incredible. I hope you are grasping what I'm saying, because when you really look at the big picture of supply and demand, like look at just right now with the cerveza sickness, how everyone's buying the toilet paper and hand sanitizer, right? See, demand was not there for those items, okay? But as soon as demand hit, okay, as soon as demand came, the supply dropped off. There's nothing available. Right? And what happens? Well, people start selling it for a ridiculous amount. This is going to happen to the price of silver. There's no demand right now, but yet the value is written on the wall. It's right there. It's in bold letters. It's saying, hey, buy me. I am undervalued and I'm going to be worth a lot more money. And honestly, if I'm wrong, can I be wrong? I guess I just do not feel like I can be wrong about this. Not with these charts, not with the data that I'm looking at. I can maybe see more of a pullback, but ultimately, like, yeah, okay, even if it drops 50% more from its point and drops under sub 10 for a physical metal that is an asset that it will never go to zero. It will never go to zero. But even if it dropped that much, it's eventually going to fly up with the price of gold. It's crazy. It's crazy. But what do I know? I'm just literally here trying to figure this out, right? Figuring out money. Now, keep in mind, once again, I'm going to leave another disclosure here. Do not go putting in all your money into something like this. Okay, this right here can preserve your wealth. So if you have consumer debt, pay that off before you throw money into something like this. Don't go getting credit card money and putting it into this. Don't take equity out of a house to put it into this. I mean, does it work for some people? Yeah, it does. But the risk there is not worth the reward. However, if you have some side money and some side cash and you want to you know what? I do want to put a few bucks into this. Then do that, okay? Don't overextend anything. Don't take money out of your stock portfolio. If you're investing for the long term, doing the dollar cost averaging, yeah, don't be pulling all that stuff around. This is just a little extra boost or maybe a hedge against your current portfolio. So be very, very careful, because this can we're in uncharted territory. This has never happened ever in history. This has never happened. So we don't know what's going to happen. All I'm doing is just looking at some data points and drawing a conclusion. Some random guy on YouTube. Okay, that's all I have for you today. Have a wonderful weekend.